Today is January 2nd, 2019. I'm John Manzella, and this is the Manzella Report. 2018 likely will be remembered for achieving solid economic growth, a highly volatile stock market, and an emerging trade war with China. In 2019, we could expect slower economic growth, continued volatility, and China to resist significant market-based reforms. Combined with an environment of political uncertainty, these and other factors could create greater risks in the year ahead. The U.S. economy is estimated to have grown by 3% last year. This rate is based on various components, including strong retail and construction sectors, and a real estate market that has slowed due to a housing shortage, rising mortgage rates, and high home prices, which have kept some buyers at the curb. And consumer spending, which represents 70% of U.S. output, is reflected in relatively strong but decreasing consumer confidence. The labor market is another issue that has real impact on the economy. The exceptionally low unemployment rate has been good for workers, but it has contributed to a labor and skills deficit that's not so good for businesses struggling to find them. Consequently, there are more than 7 million non-farm job openings that haven't been filled. Many industries, including manufacturing, construction, and trucking, are experiencing the largest labor shortages in decades. And if companies can't find the employees and skills they need, they can't grow. And this puts downward pressure on economic growth. But one of the biggest factors that will impact the U.S. economy this year is international trade. It's unlikely that China will comply with all the demands made by President Trump by March 1st, which marks the end of the 90-day trade truce agreed to by Trump and Chinese President Xi at the G20 meeting in Buenos Aires last December 1st. And here's why. For decades, China has been subsidizing its state-owned enterprises, thereby giving them an unfair competitive advantage, pressuring U.S. companies to hand over technology in exchange for market access, and placing market restrictions on U.S. companies. In addition, enforcement of Chinese intellectual property protection laws have been weak, and this has led to lost profits for U.S. companies. To adequately address many of these concerns, as well as achieve higher levels of sustainable economic growth, China really needs to press ahead with many of the market-based economic reforms it agreed to implement when it joined the World Trade Organization in December 2001. But the speed at which this might occur, if at all, could have positive or negative consequences. For example, Beijing should eliminate subsidies from its 100,000 state-owned enterprises. But to do so too quickly could cause unemployment and social unrest to rise, something that is feared by the ruling Communist Party. On the other hand, reforms initiated slowly, that in the long run would alleviate many of the trade tensions, may not satisfy the White House timetable. So how President Trump perceives China's offer in March and presents it to his base will determine if this is a win for the administration or a reason to ratchet up the trade war that could, by the way, turn into a Cold War. And the latter would generate greater uncertainty and volatility, which is the enemy of prosperity. The Federal Reserve and Wall Street Journal's economic forecasting survey predict that U.S. economic growth will decline to 2.3% this year. Now, this is based on metrics that we can see and analyze. But it's the direction of U.S.-China trade and relations, political uncertainty, volatility in the stock market, or a combination of these and other factors that could create new risks affecting the economy this year. As a result, American consumers, households, businesses, and investors should operate very cautiously. I'm John Manzella.